deep in the heart of taxes. The only show that takes the time to boil down all the tax law news that's fit to share. And some of it that isn't. Also, you don't have to. I'm Jack Manhire, your host. Let's get to the headlines. All right, right out of the gate. Last week, the Treasury Department and the IRS made it crystal clear, even though they extended tax day from April 15th of 2020 to July 15th of 2020, because of the affliction that we are experiencing, they will not do it a second time. There was some speculation that the due date for income taxes would be extended beyond July 15th, but the Treasury Department and the IRS said, nope, will not be postponed. So make sure you get everything ready. Your tax payments for 2019, as well as the first and second quarter payments for 2020, are going to be due on the same day, July 15th this year. Now, if you think you might need some extra time to file, like some people I know, you can submit what's called Form 4868, and you can get that extension until October 15th. Notice that October 15th is the normal extension date. That is not being pushed out as the original tax date was. But you still have till October 15th if you need that extension. Taxes owed, as you know, must still be paid by July 15th for tax year 2019. And in case some of you are wondering why I'm using the word affliction, there is a reason for that. Our lovely platform host, the platform on which you're listening to this right now, maybe even watching it, does not like it when people use certain words that begin with a C, let's say, in this particular case. In fact, I might even get in trouble for saying that much. But instead, I think we all know what I mean when I say that when I mention the affliction that we are living through, the affliction that we are enduring, the affliction that is the reason for all of the strangeness that's happening and some of the tax delays and dates that are being pushed back. Okay, so I might have to speak in code every once in a while because of our lovely platform hosts, who I love. You hear me, right, guys? And the NSA, I love you guys too, but I definitely love the platform host for sure. So bear with me on that. But my audience is a pretty educated audience. You guys can pick up on those codes right away, I'm sure. The affliction, speaking of it, might actually give you a little bit of a tax benefit beyond simply an extension of tax day this year. It might let you take 2020 stock losses against your 2019 capital gains. So this all is because of President Trump's disaster declaration, and that opens a certain window for some unusual tax claims. So if you're reporting net capital gains on your 2019 tax return, and if you've already taken or you would take losses this year because of bad stocks, then you might want to look into or have your accountant or your tax preparer look into Section 165I as in India of the tax code. Because it's a basic rule of the tax code that individuals cannot carry losses backward. But there is an exception for losses that are occasioned by a federally declared disaster. Now, on March 13th of 2020, President Trump declared the affliction crisis a federal emergency, and that made the whole country a disaster zone. Now, I'm sure all of you know the regular rules that if there wasn't a disaster, what you'd have to do, you wouldn't allow to carry back those losses as offsets. But losses that are attributable to a federally declared disaster can get some better treatment. And if they are attributable to the disaster, you can use them on your previous year's tax return. And this can be a big deal depending on your particular situation. Now, is the IRS going to sit still as you stand there and blame your trading losses on this affliction that we're going through? I don't know. That still remains to be seen. But when Congress put this section on disaster losses into the code, it had particular situations in mind, such as floods, tornadoes, things that destroy property, etc. So I think it would be interesting to see how this all plays out. I don't know about you guys, but my kids, I have a lot of them, and some of you know just how many I have. That's a story for a different time. But the kids I have that are older and that are working, and were working especially in tax year 2019, they're all getting refunds. They're working basically minimum wage jobs. The drill on that. So they said, Dad, do my tax return for me. So this year I changed it up a little bit, and I said, let me teach you how to do your own tax return. How about that? After a couple huffs and puffs, they actually appreciated knowing the skill. So they turned theirs in. They filed their tax returns pretty early, and I mean early February. And you know how this works. Those tax returns, the refund checks, they usually come in, within 4 weeks, 6 weeks, etc. But my kids didn't get their checks, because they did paper returns, until late May, maybe early June, some of them. And, that's longer than usual, So what happens in that case? What happens when the IRS takes a little bit longer to get to your money back? Well, the IRS can actually have to pay some interest, up to 5% interest on those late tax refunds. And of course, as many of you know, interest like that itself becomes taxable. They are issuing tax refunds at a slower pace compared to last year and previous years for a whole host of reasons having to do with the affliction. And if you receive a refund after April 15th, you also receive interest, and it can be as much as 5% on the amount that you get back from the government. Now, you still have to file by July 15th, so don't let this change what I said before. But the interesting thing, pun intended there, is that the taxable interest, I got too clever for myself there, I'm sorry, that the interest might itself be taxable for tax year 2020. And it is possible, of course, theoretically possible, that you can owe some money, owe some tax on that interest. So this next story falls under the header of scuttlebutt. And if you don't know what it means, it's an old nautical term, water cooler talk, whatever it might be. But it's from the Slate. And the headline is that Grover Norquist's anti-tax group took money from the Paycheck Protection Program. Oh my. Now, if you don't know who he is, Grover Norquist is a vocal opponent of government spending. And he said some strong words about not necessarily wanting to abolish the government, but wanting to reduce it down to the size of being able to be drowned in a bathtub. Okay, so this is someone who doesn't like government spending, and yet when the data came out on who got money from the PPP, the Paycheck Protection Program, lo and behold, Americans for Tax Reform received somewhere between $150,000 to $300,000 in small business aid. And a lot of people went ballistic. They went ballistic. So now Grover did, clarify this. He said, Americans for Tax Reform did not apply to receive the grant or any loan from the PPP. That's designed to keep people employed during the affliction. Okay. the Grover says, though, that the Americans for Tax Reform Foundation, which is a legally and financially separate research and educational 5013 entity, and was, quote, badly hurt by the government shutdown, applied to receive the loan, and as a consequence was able to receive it and keep the employees on the payroll so that they didn't have to lay them off. Now, some people are okay with that. Some people are calling foul because even though there's legally separate entities, they're both governed by essentially the same personalities. I don't want to get into that fight. It's not what we're about here on this show. But again, just shows you how things are and how they can look might not always be the same. So it pays for all of us to be careful about what we say and then what we do. Over at the Procedurally Taxing blog, Les Book reports that the recent Fifth Circuit case of Taylor-Lohmeyer v. U.S. explores the limits of the attorney-client privilege in the context of the IRS using its John Doe summons power. The IRS is seeking the identity of a law firm's client list that they represented with respect to offshore transactions. And the case provides a useful opportunity to explore the general rule that the attorney-client privilege does not extend to client identity and fee arrangements. It also shows there's a limited exception that would allow the privilege to exist when disclosure of the client identity would effectively disclose the nature of the client communication. In his post, Les summarizes the circuit court opinion, and he also highlights recent briefs that the law firm and the American College of Tax Counsel submitted in support of the law firm's request for a hearing en banc. You can go over to see Les's article in his blog, and it's Keith Fogg's blog as well, Procedurally Taxing. And one more short headline here from Tax Notes. The Tax Policy Center reported that because of the disruptions from our friend the affliction, total state tax revenue shortfalls for all 50 states will be approximately $75 billion with a B dollars in fiscal year 2020 and about $125 billion for fiscal year 21, with drops in personal income tax, general sales tax, and corporate income tax leading the decline. All right, well, that's the show for today. Now, if you liked it, please hit the like button, the thumbs up button, and then also share it. The share button's right next to the thumbs up button. And please share it to your other platforms. Facebook is the one that helps us out the most, but any platform that you use, send it to your friends and family, send it to your colleagues. We want to get this to the widest possible audience. Also, make sure to hit the subscribe button and then hit the bell icon. You have to hit both, the subscribe and the bell icon, especially if you want to take part in our future live stream chats, which I know a lot of you do. Thank you for tuning in to Deep in the Heart of Taxes. I'm Jack Manhire, wishing you many happy returns.